Bom dia, estamos aqui no Centro de Estudos Internacionais da Fundação Getúlio Vargas do Rio de Janeiro. Eu tenho o prazer de ter conosco hoje para o podcast o professor Sebastian Mallaby. O professor Mallaby, ele pertence ao Council on Foreign Relations dos Estados Unidos. Ele é diretor do Maurice Greenberg Center for Geoeconomic Studies e é um Volcker Senior Fellow for International Economics. Ele é autor de vários artigos, de um livro bastante conhecido, publicado em 2004, The World's Banker. Ele é um colunista do Washington Post e foi durante 13 anos um correspondente do Economist. Eu começo então o podcast perguntando, I begin the podcast by asking Dr. Mallaby about the current financial crisis. In your opinion, what caused this crisis?
I think there are two main causes of the financial crisis. The first, which is the one that people talk about the most, is that risk management in Wall Street particularly, but in the Western financial system generally, was terrible. You know, people invested in stupid stuff they shouldn't have invested in. They bought mortgage paper when the mortgages, the home loans to people, had been given on the basis of no documents. You could get liar loans, which meant you could lie about how much income you had when you borrowed to buy a house. So, not surprisingly, people couldn't pay back these loans. And the investors who bought those loans on Wall Street, but also sold by Wall Street all around the world to European investors, Japanese investors, and so forth, these products didn't work. They couldn't get the income they expected. And so then huge losses appeared throughout the financial system, and we got into the crisis that we've seen. But I think there's another fundamental thing underlying this, and that is the growth of savings in the emerging markets. Which essentially piled capital into the United States, drove down interest rates, so that investors became desperate for some kind of return. You could buy bonds, and the normal interest rate was so low, people wanted something a little bit more. And that's when you got this crazy financial engineering of trying to get a little bit more yield by lending to slightly riskier people, and then even riskier, and then even riskier. And so I think the imbalances that people talk about in the global economy, with China saving an enormous amount, the US consuming an enormous amount, capital flooding into the United States and driving down interest rates, that was an important part of the backdrop for the financial crisis.
Okay, and at the end of the day, do you think it was a problem of too much regulation in the financial markets or too little regulation, as most analysts would claim?
You think that most analysts say too little regulation? I think that's probably right. I agree with that. I think that is the common view. And the problem with this view is that we've experimented with regulation in lots of countries with lots of different agencies. And we don't find good examples, really, of terrifically successful regulation. So in the United States, for example, just take the United States, the Federal Reserve regulates banks, but there are 3 other federal agencies that are supposed to regulate banks. There are state regulators that regulate the insurance companies. There's the Securities and Exchange Commission. There is the Commodities Futures Trading Exchange. There is a bunch of different bodies regulating. In Europe, there was a different system, Basel II capital requirements, and in the US they had Basel I. In Britain there was a whole different series of things, yet everybody had a problem. So it's not like we have a regulatory model, except in some sort of unusual places like Canada, which did do better, because Canada is a more closed capital market. But the point I'm making is that, yes, better regulation would be good. In some cases, more regulation would be good. I think being tougher on banks and their capital would be good. But we have to be a bit modest about what we can achieve with regulation. And it's striking to me, because I spent the last 3 years writing a book about hedge funds, that hedge funds were not regulated, and they came through the crisis better than the banks, better than the insurance companies, better than the investment banks, better than the money market funds. Hedge funds did the best, and they were the least regulated. So I think we should be careful in trying to regulate a bit more, but remembering that we won't get it perfectly right.
And where do we stand at present?
I think where we stand is a sort of a tricky balance between, on the one hand, great signs of recovery in growth, both in the United States, but especially in emerging markets. And that's terrific to see, because I think in the last quarter of 2008 and the first quarter of 2009, we were really in a free fall. It was the worst experience in the global economy since the 1930s. So to have stabilized that is really a fantastic achievement by the policymakers. But it's not on a good foundation. Instead of having the US consumer being the consumer of last resort in the world economy, we now have governments spending enormous amounts, pumping money into the system, and that can't be sustained. The fiscal positions, the budget deficits of a lot of rich economies have grown so big that we're talking now that the next crisis will be that Greece defaults on its government debt, or Ireland, or Spain. I mean, there are a lot of countries which have just borrowed so much they can't borrow anymore, and the United States has a special advantage because it can borrow in the dollar. But still, the deficit is unsustainable, it's much too big. So as we squeeze back that government support for the economy, the question is, will growth collapse again, and we could be in a second recession?
A double dip, as
Yes.
it were.